Hi there, this is Alvin from Dr. Wealth. The S&P 500 representing the US stocks have been trending downwards for the past 1 month. So some investors are wondering, is this a stock market correction or is this going to be a big crash that's imminent? I'll be sharing you with my views. Hopefully by the end of the video, you will have a better understanding of what's going on and that will help you position your portfolio better. But before we begin, I have announcements to make. Today's episode is brought to you by FinBite Insights. So this FinBite Insight is started by Alvin, and that's me. And each day I will articulate my thoughts about the financial markets. Just by reading in less than 3 minutes, you will be able to get a very good understanding about what's going on, what's the most important thing that you need to know about the financial markets for that day, and how do you interpret it so that you can make better investment decisions out of it. So do remember to go to finbiteinsights.substack.com and you can subscribe it for free and start enjoying the daily insights that I'll deliver it to your inbox. Welcome back. We know that interest rate has been the cause of the stock market crash in 2022, and right now this threat of more interest rate hikes has not totally gone away. Some might even allude to the recent drop in S&P 500 is caused by this interest rate hike risk again. But I want to share with you that that's actually not the case. It is not very likely that the interest rate is going up. Okay, the Federal Reserve has probably hit the peak interest rate at 5.25% to 5.5%, and I have my reasons. Of course, it's not 100%, but I would say that it's a high probability that the interest rate will stop rising. And I get that confidence from the futures market talking about this Fed fund rate. So there will be a next FOMC meeting that's happening in September next month, and you can see that there is an 86% probability that the interest rate will stay at 5.25 to 5.5%. So there's a high chance that the Federal Reserve will not hike interest rate in September. And how about the following one, which is in November? Similarly, there's more than 50% chance that there will be no rate hike in November. And likewise for December, also more than 50% chance. So we can be quite confident that this interest rate is not going to go up until the end of the year. But how about next year? And looking at January, there is also again another more than 50% chance that it will stay at the same interest rate. Likewise for March, of course, the further we go, the probability has dropped. But something surprising in May, that the interest rate is likely to get cut, right? The most probabilistic outcome, 39% of the chance that there's a 5% to 5.25% Fed fund rate then, which means there's a cut of a 0.25%. So that is what the market is predicting. And so far, I must say that the market get it quite right in terms of forecasting this Federal Reserve behavior when it comes to interest rate. But there's one important thing I want to highlight is that I was observing the trend, and last month, the probability of a rate cut was actually in March next year and not in May. So it's like delayed another 2 months for these rate cuts to happen. So that is actually what's causing the stock market to go down, right? It is not more rate hikes, but more like the elevated interest rate is going to stay longer. Or in other words, the interest rate is going to get cut later. So that is what is happening in the stock market, and everything is readjusting to this new information. And that caused this effect, a bear steepening effect in the yield curve. So this is a diagram, or this is a chart of the US yield curve, which is the interest rate of the bonds by the US government. You can see the vertical axis is the interest rate, and then in the horizontal axis is the tenure of the bond. And right now it's obviously inverted, but I want to point to you that focus on the blue line, which is the current yield curve, and then you can see that there are two dotted lines. One is 1 month ago in green, and then the other one is 6 months ago in yellow. Maybe let me just blow this up for you so they have a bigger picture to look at. And you can see that the yield curve has shifted upwards, especially on the longer tenure. The shorter tenure had not changed much, right? Of course, from 6 months ago, the rate hikes have happened. Within that one, the short-term rates, within a year, the interest rate has gone up, right, to about 5.5%, which is currently where we are, where the Fed funds rate are currently situated at. And 1 month ago is also around at 5.5%, and which means that you can see it's not the short-term interest rate that is causing the market to go down, right? The short-term interest rate are more or less stable. Okay, the green line and the blue line are almost the same, and it's likely to continue until the end of the year and even stretches to next year May, right? Then the interest rate might get cut. You can see that the 1 year 10-year bonds or bills will start to come down in terms of the interest rate, but so far it's going to stay there for quite a while. But what's happening is that the longer tenure, right, beyond that 2 years tenure, has gone up in the interest rate. So that is what we call the bear steepener. And a simple way to understand this is that interest rate is expected to stay higher longer. Okay, it's not going to get cut so soon, and maybe the cuts will also be more moderate. So which means that the business now need to adjust to this new reality. The interest rate, long-term borrowings is going to stay higher, and they might change their plans, right? Maybe delay certain projects, and maybe they need to think about how do they posture their borrowings, restructure the borrowing so that to reflect this new reality. So it's generally not so good for growth stocks as well as those that are interest rate sensitive kind of stocks, especially those highly indebted companies. Okay, so that is why the market is correcting now to reflect or to price in this new piece of information of a more sustained high interest rate environment. Okay, so just want to be clear, right? It is not rate hikes anymore, but it's more like the rate cuts are being delayed. It's more like the elevated rates are staying here for a longer time. But that's not the reason to be bearish about the stock market. Okay, so I want to give you now some of the good news and some of the statistics. And this is a table that I pulled out and I truncated it for you. This is based on midterm election, which happened last year, right? If you have happened to watch the video last year, I was saying that the market is likely going to be bullish this year, and truth be told, it's actually happening even right now, right? Despite the drop in S&P 500, the S&P 500 has still been performing quite well year to date. And what this is showing is that if there is a midterm election, usually 1 year after the midterm election, the stock performance usually is better than a non-midterm year. So last November, that happens to be midterm year, and which means that it will stretches until the end of this year, November 2023, and there's still likely going to be an outperformance, right? So if you historically look at it, right, on the second column, where you can see that the 3 months performance after a midterm election is 7.3%, while a non-midterm average is just 2.9%. So there's an outperformance that's happening as soon as 3 months after midterm, and 6 months after, the outperformance is even greater, 15.1% for a midterm year versus a non-midterm year of 4.2%. It will stretches all the way to a year, right, which happens to be November this year, and likely the outperformance is there because historically a midterm average of 16.3% and a non-midterm average of 6.4%, right? So this is the statistics to back up that why the recent drop in S&P 500 is more like a correction than a crash. This is one of the bullish statistics to show you. And the second bullish statistics I want to share is this good first half, good second half. Okay, so if the S&P 500 in the first half have generated like more than 14% return, there is a 63% chance that the second half will also generate a positive return. So it's more than a conflict kind of a probability. And the average outperformance is 4.25%. So this year, S&P 500 has definitely outperformed 14% in the first half of this year. And hence, the statistics or the probability tell us that it is likely going to have a positive second half as well. And this is the third statistics I want to show you. And this is related to the presidential election cycle. And in the US, every 4 years there's a presidential election, and happen that the third year is usually a bullish year. Okay, so you can see year 1, year 2, year 3, year 4, right? Year 3 has the highest return of average of 13.5%, almost double of the next highest returning year, which is in year 4. Okay, so this 2023 is the third year of President Biden's cycle, and next year he's going for re-election, right? So that is why this year is likely also to be a bullish year. So I hope you understand where I'm coming from, right? So based on all these statistics and the fundamentals of what's driving the stock market drop in this recent 1 month, not sufficient to give us a reason for the stock market to crash. So a correction is more likely because the stock market has gone up pretty much this year. This is the picture of S&P 500 chart, and since the year to August, and it has climbed a lot. And I want you to focus on the rate curve, which is the 200-day moving average. So in general, my view is that when the prices are above the 200-day moving average, they are generally bullish. Okay, it's not a time to call a bet. And you can see because of the strong bull run, the prices have overstretched itself, overextended itself, right, too far away from the moving average. And the recent correction is a healthy one. To move it closer back to the 200-day moving average and such that the bull run can be more sustainable, because no stock price can go up in a one straight line. It usually moves in a zigzag manner, and now it's the zag after the zigs. So this is healthy, and it should not be something that investors should be fearful of. The way I see it is more like an opportunity to accumulate stocks, and especially stocks that have fallen into the fair price range or the fair value range where you have been waiting for. And I think that it is quite a good opportunity to look at some of these stocks that you probably have previously missed because there was just too many bad news at the start of the year, right? So now is a good time to revisit. So all in all, I think that this is a correction that's ongoing. For how long more, I'm not sure. Maybe few weeks more or up to a month, maybe down another 5% or so. And I think that this is the time for investors to pay attention, not to run away from the stock market. So I hope you get a better idea of what's going on. Now you can make a more informed decision about your own investment. Hope you like this video. Give me a thumbs up and subscribe to the channel so that you will not miss another informative video like this again. I'll see you in the next one. Goodbye.